Hello and welcome back to the Note. It's been a rather downbeat day on world markets, and that's largely because of the oil market. It opened very much higher, and then comments from Saudi Arabia's oil minister suggesting that we're not going to see a cut in supply led to a very sharp fall. Again, stocks continue to be very much correlated with oil. That was enough to bring falls in stock markets across the world. What I'd like to do now is take a look at perhaps the underlying factors behind both the sell-off that we've seen in stocks here in the States and the rebound of the last week or two. If we take a look at this first chart, which compares how utilities, the ultimate defensive dividend-paying stocks, have done compared to financials, you can see a quite remarkable rally as market confidence petered out at the end of December and in January, and you can also see it's been pegged back in the last few days. That, I would suggest, has a lot to do with dividends and the rate cycle. Utilities, whatever else they do, are very reliable dividend payers. There are greater concerns about banks and their ability to fund dividends. As, there are also concerns over their profitability. So you see this remarkable turnabout. Now, if we take a broader look at the appeal of dividends, we can compare it, if we take a look at this next chart, with the appeal of buybacks. The other obvious way that companies can return cash to shareholders is by buying back their stock. And you can see in this chart, which goes back right the way to the bottom of the market in 2009, for almost all of that period, buybacks have been extremely popular. Both the Dow Jones Dividend Yield Index, covering companies with high yields, and the buyback index, which covers companies with which buy back a particularly large proportion of their stock, have comfortably outperformed the S&P. The buyback has been far more popular until the last year. When you see that kind of decline compared to dividends, that's a sign of ebbing confidence, of a sense of show me the money. I don't want you reinvesting that money in your own stock. Mr. Executive, I'd like to have it in my own pocket, please. Now, if we take a look at that in more detail over the last year, you can see that the relative performance of buyback stocks compared to yielding stocks correlates almost perfectly with the performance of the S&P 500 as a whole. As confidence in the buyback phenomenon ebbed, as people decided they wanted to be shown the money instead, so the S&P fell. How do we explain this latest rebound? Well, it could well be down to what is known in the trade as the buyback bid. Companies are not generally allowed to buy back their own stock during the window ahead of their earnings announcements. Therefore, it's as earnings season comes to an end that you will see more buybacks entering the market, and that tends to push up stocks. That has obviously happened very clearly this time. Given that this is largely technically driven, and given that we've seen over the last year that the efficacy, the power of buybacks to keep the market up is waning, to say the least, that suggests that this rally is not particularly strong, barring continued strong economic data, and certainly that's also part of the rebound of the last week, that the economic data here in the States has been better. It would be unwise to expect the rally to go on much longer.